It's great to have you join us again. Welcome to Capital Market. I'm Temple Ashaju. This evening on the program, we take a look at the situation in the market. It's now public knowledge that the macroeconomic terrain saw much of turbulence all through the first half of the year, and this is orchestrated by the persistent deteriorating macroeconomic variables. A contracted GDP of 0.4% for the first time in 13 years, lower oil prices, scarcity of foreign exchange, rising inflation rates, as well as delayed fiscal stimulus all depressed economic activities in the period. These challenges had its effects on listed companies throughout the period in question, as reflected in the second quarter earnings and first half results, which were largely weak. More significantly is the implications on the banking and manufacturing sectors, while the downstream oil and gas firms defied the trend as a result of the partial subsidy removal introduced in May. With the current situation of things, the board of most companies have resolved to shore up liquidity and bypass the loss position with fresh capital raising. How and why this must be made possible will take the center stage this evening on Capital Market, as we will be joined later on the program by a stock trader and analyst to help us answer these questions. Join us after this news segment.
Following the central bank's removal of restrictions and check deposits into savings accounts, the Securities and Exchange Commission, SEC, has announced that dividend warrants can also be credited into such accounts. According to the SEC, the development is part of measures taken to put an end to the growth in unclaimed dividends in the country. The guidelines, which was released during the week, is a collaborative effort between the CBN, the Nigerian Interbank Settlement System, commercial banks, the central bank, and the Commission. The product of the synergy is the development of an e-dividend mandates management system which enrolls investors through bank verification numbers. Leading energy provider Forte Oil is looking to improve its operating margins and diversify revenue base by the second half of the year. This strategy is coming after the company declared 69% increase in pre-tax profit for the first half of the year. During the week, the management of the company explained that it will also show up capital via a 50 billion naira bond floating.
We are on track to hit our PBT of 11 billion. Yes, now we have about 4.2 at the group level, and this has been impacted because of the major overhaul of the Geregu power plants. Now that we have 3 turbines, the way the budget has been worked on is that not all the turbines were meant to run for first half of 2016. So in the second half of 2016, we have the 3 turbines running. I will not be surprised even if we surpass the budget. So that's why we did not go around it, because I've mentioned that we're on track to at least attain the budget for that period.
With respect to borrowing, you mentioned that borrowing grew by 5 billion. That is correct. However, the growth of 5 billion relates to our power business. Like the GCO mentioned, we embarked on a major overhaul last year, and we just finalized it. So we got BOI funds through First Bank of Nigeria. So that also addresses your question around increase in cost. What we've done is that for the 5 billion additional debt raised for this major overhaul, we actually got BOI intervention fund, which was way below the market cost. So I think that addresses your concern around growing debt and the implication for our interest cost. With respect to sustainability of growth, given that PMS contributed a large chunk of, like the GCO mentioned in his presentation, PMS with respect to revenue is always a large chunk, but when you get to the gross margin PBT level, you begin to realize that PMS almost fizzles out. I mean, the way to look at it is with a selling price of 145, the margin per liter is in the region of 5 naira. That is way below 5%. But as a company, we actually did about 13% because the bulk of the gross margin came from lubricants business and other key businesses that give us high margins. This particular event isn't geared towards raising capital. Our reason for coming here today is to present information to you that you could price into our stock, is to let you know that we are transparent, to prove to you what our corporate governance structure is, to also let you know that we are as open as a book, and you can always come to us to ask questions with respect to anything, with respect to your own company. So today it is not about capital raise. However, are we coming anytime soon? The answer might be yes.
Dangote Cement is set to begin coal mining as a substitute for gas in cement production by the fourth quarter of the year. During the market briefing of the cement giant at the stock exchange, the company explains the reasons for diversifying from kiln fuel to coal.
Dangote Cement is Nigeria's stock market leader by capitalization. Its revenue grew 20.6% in the first half of the year, with the group's cement volume soaring about 60% in the same period. However, earnings before interest and tax fell by 10.2%. At this briefing with market operators, the group managing director, Mr. One van der Wedge, explains how the 45.4% margin was realized on lower selling price and higher fuel costs.
Like we are doing in Nigeria, we had to convert our facilities so that they can run on both coal and gas. Unfortunately, the gas and the coal is not yet available. So like here, we have a much higher cost in Tanzania until we have our new plant ready. So that is why this startup loss of Tanzania reduces the profitability in this region.
To remedy the situation, Dangote Cement resolves to begin coal mining at Ankpa, Kogi State, in order to save foreign exchange and de-risk fuel supplies.
With our own coal mine, we want to do our own coal mills. We want to do trucks, we want to do exports. So we are looking at what can help us reduce our dependency of Forex, because once we don't have to import fuel anymore, it will save a lot of Forex for us and for the country. We are looking at a lot of where spending the capex to reduce our costs.
Dangote Cement is currently active in 7 African countries. While Congo and Sierra Leone are anticipated on stream in October, the strategic protection of margins in Nigeria is expected to enhance strong volume growth.
During the week, Ashaka Cement released its half-year result for the period ended June the 30th. While most of the headline indicators ended in the south, other income lines grew 212% as profit before tax weakened 59% on sales decline. Ashaka Cement saw reclassification of costs from operating expenses, which explains the negative margin of 3.2% and a 23% decline. The profit after tax narrowed by 47%, following a tax credit of 170 million naira. Cutex PLC has declared a 20.24% rise in revenue for the calendar year 2016, which ended in April. The listed company saw profit before tax appreciating by 37.61% to 278.11 million naira. Post-tax profit also soared by more than 27% to 190.5 million naira. Cutex, one of the active companies of the Bourse, however, gave no explanations for the positive record. Pharmaceutical sector listed firm May & Baker is one of the companies impressing investors with excellent performance in the first half of the year. The diversified manufacturer of pharmaceutical products and beverages reported 3.70 billion naira as revenue, higher than the 3.40 billion naira recorded in the corresponding period. While pre-tax profit came in at 44.24 million naira, profit after taxes stood at 30.89 million naira. May & Baker also increased earnings per share marginally to 3 naira 7 kobo.